start. From here, and you use this. Okay. I'm just saying a few words, and then you can go. Okay. Good morning. My name is Carole Gresse. My pleasure to chair this session on order books. We are running a bit late, so I think we need to start now. And the first speaker is Natascha from École Polytechnique, presenting concave cross-impact. The floor is yours.
Okay. Hello. Perfect. Okay, so thanks a lot that I can be here to present my work on concave cross-impact. I'm not so sure if it just belongs to the order book session, but as well as to optimal trading. And the paper is based essentially also on the paper that we have written before. So now we are looking at concave cross-impact, meaning like we are looking at a whole portfolio on how we should trade them optimally, given that impact is a non-linear function. And this was based on the single asset case trading with concave price impact. And there's related work. So why is our paper so special? Because impact to derive optimal execution principles, usually having non-linear relationships is difficult to handle analytically. So there's a lot of work on linear impact and also cross-impact, concave impact, but not really with decay. So you would have Almgren, for instance, that would just have like an instantaneous decay. But there's also this Alfonsi fruit and sheet model that our work is based on, that are able to have an optimal solution with concave impact, but just in the single asset case. And there are other paper, linear cross-impact, also from Alfonsi, but they are just deriving some no arbitrage conditions on the matrices. There's also one that is not listed from Eduardo Abijaber, Eyal, and Sturmius that also tackled that problem last year. And we will also talk about what are these no arbitrage conditions that we need to satisfy, that the model needs to satisfy when we are considering a multivariate case, when we are considering trading with a whole portfolio. And just to have a quick outline here, I will introduce to you the model that the impact model that our work is based on, this Alfonsi fruit and sheet model, the AFS model, that is a concave, nonlinear impact model with exponential impact decay. And then I will show you some empirical evidence that cross-impact is in fact observable and that it's a concave function. Then we go to those like no arbitrage conditions. So we want to optimize our P&L with respect to an alpha that we have and the transaction cost. And we will see what are the no arbitrage conditions on the model that we need to impose for the cross impact. And apparently we are able to solve it because there's a little graph that shows the solution for the optimization problem. And I'm affiliated as well to Capital Fund Management. So we have a data set of meta orders, and we can even see, we can empirically fit our model that we are creating here. So let's start with impact. What are the properties of impact? In general, let's just consider price, the peak impact as the average of this difference when I start my meta order and the end of the meta order. So I just want to say, like, so a meta order, large hedge funds, for instance, they need to split their big chunk, what they want to buy, into smaller child orders. So the whole volume of the meta order is Q here. And ADV, so we want to take the volume fraction of, do we trade maybe 10% of the average daily traded volume? So we want to condition the price change on how much we are trading, and we see that we can model this with the concave function. So here I'm calling the concavity parameter C, and we are observing, this is a log-log plot, that this is the slope, which is about 1/2. So we see that the peak impact is a concave function. But what we can also observe in the market is that we trade during the day, and as soon as we stop trading, impact decays again. So we don't only need like a concave function of the peak impact while we are trading, but as well, if we are trading on multiple days, let's say, we need to take into account how our impact is still lingering in the market. So therefore, we have this, we have DQ. DQ is essentially the amount, the child order, the volume of the child order that we are trading. And then we are introducing this exponentially weighted moving average, this latent variable J, to have some dynamics in our impact. And then the price impact I is what we observed before, is just a return that is caused by our trading. But because we now introduce this like exponential weighted moving average, J, we also have some impact decay in our framework. And this is essentially this AFS model, the Alfonsi fruit and sheet model, and where if C is 1, then we would just have the Obija-Eber and Wang model, where we have linear impact with exponential decay. So what does this have to do with what I want to talk? So essentially, there are many papers already, and, including also our previous paper on trading with concave price impact. In the single case, in the single asset case, that we were able to derive optimal execution principles. But the problem is when we are dealing with a whole portfolio, we have many correlated assets in that portfolio. Think about you want to trade futures and you have the same underlying, like let's say a corn contract, but you have different expiries, like corn in 1 month, 1 quarter, or in 2 quarters. So these assets would be highly correlated. And let's say now we have like a corn contract I and another corn contract J. We are trading contract I and observe the price change in contract J. And we see if we trade them both at the same time, then we have an increased impact. Whereas when we only trade one, but not the other one, we can still observe that we induce a price change. So there's like some cross impact visible, and if we trade in opposite direction, then the net impact actually just cancels more or less out. And this is very important when we're considering trading a whole portfolio. So what I've introduced to you before, this AFS model, in this paper now, we take that and try to build a multivariate case where we vectorize all the quantities. So we are trading D assets here. And so price impact becomes a vector. Our holdings Q become vectorized for D assets. And before we had a push factor, how much we actually push the price, which was a scalar, lambda, which is now a matrix that needs to incorporate the correlation structure, the return correlations that we can actually measure. And as well, we need to introduce a matrix that incorporates the decay timescales, B, and a matrix L that includes the liquidity factors. But to trade, we also need an alpha signal, actually. So coming back to this optimal execution problem, before I was introducing how we are pushing the price impact modes, but we are trading because we have some return prediction alpha. And here I just want to quickly introduce the alpha, how we are defining it. It is the difference, the predicted difference in the fundamental price over some time horizon h. And I just want to give 2 examples of what are those alphas in the market. For instance, they can be constant. This would be more long-term alpha, like based on fundamental analysis, for instance, where we say, okay, the price in a couple of months will be at that point. So while we are executing our meta order, say during 1 day, the fundamental price doesn't really change. Whereas on the right-hand side, we could also define a news alpha. So we need to take into account that our alpha during our execution is already decaying. Say there's earnings news of a company at 10 a.m. in the morning, and during the day, the alpha is already decaying during our execution. So the whole motivation of this talk is like, okay, we have alphas of a whole portfolio, and we also know with this new model how price impact will move. And we want to see, like, okay, I'm a portfolio manager now. How can I optimize my returns with respect to my transaction costs? So I want to choose how much I'm trading, giving an alpha signal, essentially, over some execution time horizon that we just say, okay, it's intraday execution time horizon to avoid any overnight effects. And let's go to our goal function. Essentially, we have a risk-neutral P&L, so we don't consider any inventory, and we just say, okay, we have a profit, which is our alpha term. We have our transaction cost in terms of impact, and we want to maximize this in terms of DQ, in terms of how much we are trading. And here comes this nice trick. We introduced this latent variable j before, and we can rewrite DQ in terms of j, because it was like j was just an exponentially decaying function where the source term was q. And impact is just the concave function of j. So essentially we can map our problem into impact space, and we can solve it in a sense. In a single asset case we can solve it immediately, but now in this multivariate space, so I'm introducing the variables theta and theta, which are just like some rotations of the push factor matrix and the push factor matrix and the decay matrix together. To ease notation, theta and theta will be very important. And we can solve this problem for the dt terms in front of the dt. This can be actually point-wise maximized. However, this other term, the theta matrix that couples those j's, this different j's of different alphas, of different assets, they don't have a common antiderivative. So we cannot use any Ito trick or anything to solve this if theta has an off-diagonal, for instance. If they do only have diagonal terms, then we would be able to solve it with Ito's lemma. So therefore we were asking ourselves, should we give up, or should we try to find conditions on theta and theta to have a well-posed problem and are able to solve our optimal execution problem? So for that, we were inspired by Jim Gatherell's paper from 2010, where he was like introducing no price manipulation conditions given a round trip. What is a round trip trade? So we start at time 0 to trade. Let's say we buy some asset, underlying asset, and then until t, we liquidate our position so that at the end of our trading, trade interval, we have a 0 position. And with that, we should induce some costs. So there's no arbitrage condition that with a round trip trade, we need, like this trade must have cost something, or at least it's 0. So if there would be negative costs, this means we can trade back and forth by actually making money. And this is not allowed, and we should not, this should not be possible. So with a round trip condition and there's no arbitrage condition, we try to derive rules on theta and theta. And we need to, here now comes the creative part. So we had to think about what could be possible trading strategies to isolate the theta and the theta role. Theta was in the dt term, so theta couples both the j's. And we can single out the theta terms by just having like a symmetric strategy and the no arbitrage conditions. So we put this strategy into our impact cost, and we see that, okay, the time-dependent term actually singles out, and then we have the costs now need to be just larger than 0. And okay, we have a lemma. So what are the conditions? What are the no arbitrage conditions on this matrix theta? And essentially it turns out for like if C is equal to 1, where we have linear impact, and this was already studied by Alfonsi, Fruit, and Cheat. They also observed, okay, we need the matrix to be positive semi-definite. So, and for the case where the concavity parameter is 1/2, then we get something that is less intuitive. And I want to show you now on the right-hand side, like if the matrix theta is symmetric, then for the linear impact case and the concave impact case, the condition doesn't really change. So essentially, if you have a symmetric matrix, you don't need to take into account any weird complex eigenvalues of the matrix. You really you recover the conditions that have been derived in the linear case. Whereas on the left-hand side, if it's not symmetric, then it becomes a bit more involved. However, like as long as the matrix theta is positive semi-definite, it should be fine. Or let's say that the eigenvalues have to be positive of that matrix. And now let's come to a more interesting case with the theta matrix. So essentially now think about how can you actually have price manipulation conditions in the how can you have yes, thank you. Okay, how can you make money? What are cases actually in the real world where people make money? You have those pump and dump. You have those pump and dump strategies where you trade super quick, you push the price up, and then you slowly unwind. So we took this as a inspiration to, okay, how can we have like strategies where they are smooth, that we can really make like analytical calculations with. So we take those Gaussian kernels because we all love Gaussian kernels. They're exponential and it's easy to work with them. And then we just tune the variance of that kernel and the mean. So with the variance, we can control the speed of our strategy, and the mean would say like, okay, one strategy is just in front of the other. So we are pushing the price quickly up, the price is going up of the other asset, and then we slowly unwind our position. And so just to just to briefly say that, okay, actually it shows that the theta matrix, if we have linear impact, needs to be symmetric. And for the concave impact case, which is the case that we are looking at, the theta matrix needs to be diagonal. And this helps us actually to solve the problem of our P&L, because there were these like cross terms that didn't have a common antiderivative. And now those terms are essentially gone. So by considering no arbitrage conditions, we are able to reduce the space of models and are then able to have analytical and tractable solutions. We have like 3 cases where we were able to solve this. So let's look at the decoupled case, just as an example. So the optimal impact space has actually this very easy kind of formula. So if we are just considering a constant alpha, we can even forget the second term. So it's only our alpha over 1 plus c. So in the concave case, it's like 0.5. And then now let's convert this back to our really trading speed. So the impact is coupled due to with this J latent variable that is coupled to actually how much we are supposed to trade. And let's take a look at 2 stocks that would have a correlation of around 60%. This is kind of what you would observe in stock markets where you have companies in the same sector. Then, if they have the same alpha, you would reduce your trading speed by 1/2. Whereas when you have like an opposite alpha, then you would reduce, then you can actually trade way more because you would trade in opposite direction and you are able to reduce the net price. And just to say, like we did the fit of, or can we actually measure this on empirical data, which can be very tricky with meta orders, because with meta orders you don't have so much data. So I have this CFM proprietary data set of 100,000 meta orders, where we see like agricultural products and energy products, and they all have very interesting return correlation structures. Like on the right-hand side, they have the same, I mean, it's literally a derivative of oil, kind of. On the left-hand side, you have like high correlations in the contracts themselves. And so in the bivariate case, when you just take like two assets and try to compute their cross impact, we want to fit the concavity measure C, what should be 0.5, and the decay time scale, what was a part of this B matrix, right? So we want to compute these parameters, and we see that cross impact is a concave function. Moreover, let's bin those, thank you, let's bin those assets, like these pairwise assets, let's bin those in return correlation bins, saying like, okay, you have assets that have 90% return correlation, 80% or 30%, and you see that the concavity parameters is always like non-linear, so it's clearly under 1, and you are able to derive even the dynamics of that system. And just to say, like, when you consider what is more important, self-impact or cross-impact, here, this is the last panel, you see it's almost like 50%, like cross-impact is accounting almost 50% for the price change if you have those very, very highly correlated products. And essentially, to finish up, we see that we were able to derive a first optimal execution principle with a non-linear cross-impact model and with exponentially decay. And we also saw that those kind of models are in general hard to solve, if to solve at all analytically. But one can always reduce the space of models if you consider no arbitrage conditions. And moreover, we were able to show that this model is empirically as well relevant, even for the meta-order case where we only have like 100,000 data points. We are able to calibrate this model and see that non-linearity is a feature, and we are able also to measure the impact decay. Thank you.
We now move to the second paper, and then we will have a discussion for those two papers. And then we will take questions for the two papers, okay? So if we have questions for Natascha, please keep them in memory, and then we can take them. Thank you. So now we have Matthieu Garcin presenting estimation of bidder spreads in the presence of serial dependence.
Okay, thank you for giving me the opportunity to present this work, which I wrote with two students of mine. And today the question is about estimating bid-ask spreads, which may be a very simple question, in fact, when you observe the order book, because in your order book you can directly observe what is the bid-ask spread. So this could be the end of my presentation. But in fact, here, what we're interested in is a set of assets which are less liquid and for which you don't specifically observe high-frequency observations. And so for this kind of assets, which may be small caps, mid caps, or maybe corporate bonds, for this kind of assets, what people can do is just considering the time series of prices, and from this time series of prices, try to build an estimator of bid-ask spreads. The question may also be relevant when you're just an investor at a low frequency and you want to know what is the aggregated bid-ask spread over, say, 1 hour or 1 day. Okay, you can observe in the limit order book the bid-ask spread right now, but you don't have an aggregated view of what is the bid-ask spread and how can you aggregate this bid-ask spread. Maybe you can just take a time average, but why is this time average and not another method? Our framework is one of time series. So we have a time series of prices, which is PT, which is the time series of prices that you observe, but which in fact is not exactly the true price of your asset. Okay, you have the mid price, which is P star here, and the price that you observe diverges from this true price. Okay, it diverges from it with a bid-ask spread. So you have S, which is a spread which is constant over our time interval that we consider. And then if we consider the logarithm, we have the lowercase equation for which we simply have the observed price, which is the mid price, mid-log price, plus a microstructure noise, which contains our bid-ask spread. Okay, so the question is, what is the value of S, this bid-ask spread? And this is, in fact, a classical question in econometrics, and there have been several proposals to address this question. The first one is the approach proposed by Roll, which simply consists in considering the autocovariance of the price. Okay. Then we can consider another approach proposed by Corvin and Schutz, which is based on high and low prices. So it's more or less the same idea as a Parkinson volatility applied to bid-ask spread. And then there are some extension mixing it with moments. And the last proposal is the one by Ardia and co-author, which extends the first estimator, the whole estimator, including some trick to bypass the case where you don't observe trades. Okay, so very illiquid markets. And then they also proposed an estimator which includes open, high, low, and close prices, so very rich estimator. So what is our contribution in this work? We find that all these estimators are nice, but they just don't consider a particular case, which is a case where you have some serial dependence either between the prices or between the trades. And if you include some serial dependence, you observe that there is a big bias in all these estimators. So what we just want to do is to propose some estimators which are robust to this serial dependence. Okay, and our approach will not be based on a high-low range, but it will be based more on a moment approach, and we won't consider autocovariance, but just simply variance of price increments, and it will be enough. Let's go directly to the model. So here, what we're going to do is we're going to estimate not the spread itself, but the squared version of the spread, which is the classical way people do in econometrics, just easier. And the difficulty with that is that we may have an estimator which is negative, which is not a good thing for the squared variable. And so we have to use some correction to get the estimator of the spread and to take into account that it has to be positive. So this works quite well, except in the case where we have very small spreads, which is not the one we're interested in here in particular. In fact, why is it a problem when the spread is small? Simply because your asymptotic results, your asymptotic theory for your estimator will not work anymore, in fact. So we consider three models. The first model is our baseline model, in which we don't consider any serial dependence between prices and between the microstructure noise. Then in the second model, we will introduce some serial dependence in the time series of mid prices, and in the third model, we'll consider serial dependence between serial dependence for the microstructure noise. We also have a fourth model in which we include both serial dependence for mid prices and for microstructure noise, but I won't present it today because it will be too long. Also, we have an important assumption, which is that we don't have any dependence between the mid price and the microstructure price. It is a very convenient assumption, which is quite classical. Maybe we could do better, but at least for the first attempt, it is logical to try with a simplifying assumption. Okay, so we have n observations, and now we consider the first model, and then we'll consider the two other models. So in the first model, so we consider that we have a Brownian motion for the mid price, the log mid price, and we have an independent time series for microstructure noise, and we can calculate the variance of an increment of the log price, so which is the quantity V, and you see that this quantity V can be split in two parts, one which is related to the diffusive part, so we observe that we have sigma squared, which is the variance parameter of the Brownian motion, and we have another part which is related to the spread. And so, if we are interested in the spread, we can just consider two variances of two different time steps, and we will be able to filter the diffusive part and just recover the spread. And so, we have this equation in the middle of the page, where you see that we have on the the right-hand side of the equation, we have the spread, and on the left-hand side equation, we have two variances of our time series. So now, in order to build an estimator, we just have to replace this variance by an empirical variance, and there are several ways to do that, either considering overlapping increments or non-overlapping increments or disjoint increments. This will simply change, in fact, the statistical properties of our estimator, but that's all. Okay, so maybe it's more technical point, and we can just consider that we can use an empirical estimator of the variance. And so once we have an our empirical estimator of the variance, we can study some properties of this estimator. So we have, for example, the variance of the empirical variance, which depends also, of course, of the technique we've used to define what is this empirical variance. But what is more interesting is the theorem below, which gives in red the estimator for the squared beta spread, and we can see that we relate it directly to empirical variances, and we have the consistency of this estimator, which is strongly consistent in the case where, in one of our technical cases where we computed our empirical variance in a certain way where we have a disjoint increment of prices, but another way we have a consistent estimator. We also have a Gaussian distribution, Gaussian asymptotic distribution for our estimator, and so we have all the useful properties to understand how our estimator behaves. And then a more practical question is, how does it work with simulations? And so what we did is simply simulating data which are consistent with this model, so very simple model, and we compare all the estimators. So we have two blocks, one with the traditional time series estimators of beta spread, and the second block is the one with our own estimators. So here we're interested in the first line of the second block, and we can observe the bias, standard deviation, quadratic risk, and we see that it behaves quite well. Even though we have a variance which is not the lowest of all the estimators. But what it is interesting also, if you consider, for example, Corvin and Schut estimator, which is the first one, you see that it has a small bias, but also a very small standard deviation, which means that if you compare the true value of the spread that we know with this distribution of the estimator, in fact, the true value of the spread is quite unlikely. So we would reject the true value of the spread. So in fact, it is we have here a significant bias, so we have to reject this kind of estimator, which is not the case, hopefully, of our own estimator, which gives satisfying results regarding this statistical test. If we compare here in this graph several estimators, what we have here is on the abscissa the true spread, and on the ordinate we have the difference between our estimator and the spread, the true spread. So ideally it should be close to 0, and we compare here 3 estimators. In black it is our own estimator. We see that it is indeed very close to 0. Okay, the solid line is very close to 0. It is the average of our estimator, and if you consider the dotted line, they are just the average plus the standard deviation, so it is a bit large compared to other estimators, but we see that 0 is indeed in this kind of confidence interval, which is quite satisfying compared to other estimators. Okay, let's go to the second framework, where we consider that we have some serial dependence for price increments, and this is possible, for example, by using fractional Brownian motion for describing the log price, so replacing the standard Brownian motion. So I guess most of you know what is a fractional Brownian motion. It is just an extension of a Brownian motion in which we have added some serial dependence between the increments. Okay, everything else is the same, and we also have a time continuous definition of what is the fractional Brownian motion. But what is interesting is interpretation of the Hurst exponent. You see that when the Hurst exponent, h, which is important parameter here of this model, when this Hurst exponent is equal to 1/2, the fractional Brownian motion is simply the standard Brownian motion. So we're in the basic situation. When h is higher than 1/2, then we have a positive autocorrelation of price increments, and when h is lower than 1/2, then we have a negative autocorrelation. Okay, and so here our model is simply that we consider that the mid-price, the log mid-price, is an FBM with a Hurst exponent which can either be higher or lower than 1/2, and the microstructure nose is unchanged. So in this situation, if we use our former estimator, we observe that there is a bias, and we can calculate precisely what is this bias. It is in my red box. You see the bias, which depends, of course, of the Hurst exponent. And if you consider that h is 1/2, you find that the bias is equal to 0. Okay, we have exactly the same bias for all estimator. So it is something which is very common. And this bias, for example, when h is lower than 1/2, this bias is positive. And when h is higher than 1/2, the bias is negative. So once again, we can calculate the variance of our price increment. And once again, we have 2 parts, and this time the spread part is unchanged, but the diffusive part has been modified by the Hurst exponent, and so it is a bit more complicated to get rid from this part, so we can try to do that. We have our red estimator, in which you see that it depends on the Hurst exponent, which is unobserved. So we have also to estimate the Hurst exponent and then to plug into this estimator, so which will create some difficulties. In particular, when the Hurst exponent is higher than 1/2. When it is lower than 1/2, it works quite well. Okay, so we have our estimator of the Hurst exponent, which is also based on variance of price increments. And finally, what do we get as a result? Here, it's the case where the Hurst exponent is lower than 1/2. We see that if we directly go to the statistical test, we only have 2 estimators which are accepted, the one we have just introduced and the one which is GK, which is one of Ardia and co-author. Okay, so it is quite satisfying, and we'll see, if you observe the bias, that all the estimators have a positive bias, except S2, which is the one which is specific to the situation, which has a very small bias, which is negative, but very close to 0. Okay, so here we see the same kind of graph. The black line is the one which corresponds to our estimator, and we see that it is indeed close to 0 compared to other estimators. We have something which is not so not so positive for H higher than 1/2, but it is satisfying but not exceptional. And if we go now to the third case, now we go back to a Brownian motion for the price, for the log price. Okay, so no serial dependence for mid price. But this time we introduce some serial dependence for the trades, meaning that our microstructure noise is a correlated random variable with an exponential decay of the autocorrelation, which is something which is quite standard and which corresponds to a discrete version of an Einstein-Uhlenbeck process. Okay, we imagine that we have a latent Einstein-Uhlenbeck process for the microstructure noise, and we observe it at discrete times. Okay, and so we have these exponential, not discrete times, but discrete values, because our microstructure noise is simply plus S divided by 2 or minus S divided by 2. So we have simply two possible values for our microstructure noise. And so that's this discretization of the values of the Einstein-Uhlenbeck, which leads to this kind of exponentially decaying correlation. Okay, now if we have this situation, how do traditional estimators behave? They have also a bias. Okay, we can once again calculate the bias, and this bias will be negative. Once again, we can calculate the variance of the increment of our log price, and we see that we once again have two parts. Now the parts which has been changed is the one with the spread, which is a bit more complicated, and we have here to get an estimator for the value of lambda, which is the speed at which our autocorrelation is decaying. And so once again, we can calculate a plugin, calculate an estimator for lambda and plug it into the estimator of the spread, and we get another estimator. Once again, we're able to have some statistical results regarding the consistency as well as the Gaussian distribution, the asymptotic Gaussian distribution of this kind of estimator. So some strong statistical results in a quite difficult situation because of this serial dependence. So we have to use some alpha mixing conditions for the technical part. And now what we get as the results, if you compare all the estimators, you see that they are all rejected almost. Okay, just S2 and S3, S3 being the one corresponding to our case, just these two estimators are not rejected. And we also see that all the estimators have a negative bias, as expected. And our estimator is just the one with the smallest bias. Okay, so we can also compare this, but maybe I can go directly to the conclusion. If we compare our results with, if we calculate our spreads in the case of real data here, that's just an average over the 40 constituents of the CAC 40 index, and we compare it with the displayed BDASK spread over a day, then we see that we can calculate some metrics for the accuracy of all the estimators, and we see that our estimators behave quite well, and we have also tried to link this performance to the nature of each stock. If it is, we can try to relate it to the capitalization, in fact, and we see that depending on the stocks, we have some behaviors which are improved when we have, for example, higher capitalization. Okay, and that's all for my presentation. Thank you for your attention.
Matthieu. And our pensioner from Dauphine is going to discuss the two papers. So good luck.
Yep. Yeah. Just waiting for the slide. So it's a pleasure to be here to discuss these two papers that tackle, in fact, a same problem, which are those hidden costs. You should take into account when backtesting a strategy or taking a decisions, which are the impact or the spreads. So the organizer did a great job at making these two papers one after the other. So let's start on the first paper, which is about concave cross impacts, which is about to make a consistent model that merge two parts of the literature, which are cross impacts and the concavity of the impacts. Yep. So to do a small first recap for the one not used to price impact is just by how much you will move the price when trading a large quantity, often with a major order, an order of the time. And this impact is a cost for you, because like you are going to buy more and more expensive, and so you need to take them into account. And there is a law which is known as the square root law, which is an observation that has been made like more than 30 years ago, and which is quite reliable, that shows that the impact you are going to have depends on the volatility on the asset and the square root of the proportion you are trading. Now, if we move to cross impacts, it's quite intuitive to imagine if I'm trading the spot and I make the price move, of course the derivative product will move. And if I'm going to do a backtest where I'm going to roll my position of my future, of course I should take into account these phenomena. The same way, if I'm trading the two futures in the same direction, if I don't take this into account, I will greatly underestimate the associated cost and take bad decision. So what the author proposed is modelization, a framework to be able to modelize that. And in the framework, here is the graph. We have the orange case where we have no simultaneous trade in the two assets. And if we have trade in the same directions, we can see we have a greater impact. If we didn't use their cross-impact model, we will still be in the orange case. So we would be far from the reality. And in the rolling case of future, we would be in the gray case in the author's model. So if we move to what's challenging in that, well, the challenge is to be able to propose a consistent model. What's hard is to say a model is consistent, is to have a model where you can't abuse the model to create round-trip trades, which is like you can't buy and then sell and use the impact to make money. And why it's hard, because if you look at the literature, there is already cross impacts model, but that are linear, because in linear setups, it's much easier to enforce these conditions. But when you start to add some concavity, it became way harder. And the outcome the author achieved to obtain from the paper is not just creating a framework, but to have practical parameter restrictions to be able to use this on real data. So the starting point is that they took the Alfonsi-Froust-Sheed model, which depicts the impact as a function h, which is a concave function, so sine of x times x power c with c between 0 and 1, of gt. And gt is an exponential decay of the past trade. So basically, you take the last value, you apply a decay parameter, and you have a push factor on the new trade you are going to do. So it seemed quite a natural representation. And the first thing the authors naturally did is, if you want to have a cross impact, you just need to change your parameters with d times d matrix if you have d assets. So they just changed the original notations to be able to have matrix of size d times d to link the trades in each asset to the impact in each other asset. Quite natural. Now the difficulty comes to the part where you need to enforce the non-manipulation constraints in this condition. And well, I won't redo all the what they do. I will just use the main results they obtain. Is that a good condition to be able to have something that works is to have the matrix theta, which is just the product of the matrix L transpose, that the push factor, the inverse push factor should be diagonal. That do not mean that this matrix L and lambda are diagonal, because if that was the case, there wouldn't be any cross impacts, but that's just the result of this multiplication that should be diagonal. The great thing they did just after, they choose like a more concrete example with the two assets, and they choose the L matrix as the square root of the covariance matrix, which is quite common because if you look, usually you have in the square root law, you take the volatility of the asset. So here you just have the square root of the covariance matrix, which is in cross impact, makes sense. And they are able to calibrate the model on the meta order they depict before. And they also, of course, propose a matrix to just we just measure the sensitivity of the impact to the on trading to be able to see whether the cross impact is important or not. So what they observed is that first the estimated concavity on their order is between 0.5 and 0.7. What does that mean? That means that even in cross-impacts model, we need to have this concavity, so the works make sense to be used. They also observed the decay rate, and what they observed, more importantly, is that the gross impact accounts for up to 50% of the total impact in highly correlated assets. So that's something you should take into account. Another way to see it is that if you look at the R squared of the two regressions they used in the paper, the R squared in the case with the gross impact was like 20% higher, so it depicts more the reality than in the self-impact case. There is still work to do. I think that's a great starting point, but work to do not necessarily for the authors, but for other people that want to use it, that how to use it beyond like the two asset examples. With more assets is still quite challenging. There is a note on the authors that I pretty agree with. That is the difficulty of this paper is to be able to have these non-manipulation constraints, and that creating more parameterized model, like ML model, would fall short to achieve the respect of this condition. And even if I largely agree, if I would start to think about this problem, the orientation I will take would not be standard machine learning, but maybe deep learning, as it's more expressive to include this condition. It could be like a future ID for the future. But overall, that's a quite great paper, very rigorous, and that better represent the cross impact in a more realistic setup that merge the square root ID with the cross impact ID. Yeah, so let's move on to the second paper. So another hidden cost, less hidden as the impact, which is the beta spread, and less hidden because you can observe it in certain conditions or if you want to. But it's still a cost because what is the beta spread for the ones that don't know? It's just the difference between the best bid and the best ask in the order book. And so if you are going to trade aggressively, you will pay this difference of price. Okay. The thing is that it's either not observable, either hard to observe because to observe it, either it can be very costly, for example, to pay the subscription to Bloomberg to have this data, or either it can be a pain to process because like I read this study only on one or two derivative contracts on crypto, and it was already over 6 months, 150 gigabytes of data. So maybe having an accurate daily average of the estimator is something valuable for most people that are not high-frequency traders. So what the authors propose is to take a simple base market model where what we observed is we have the observed price PT, which is like we have a mid price, and either the transaction that occurs is a buy or a sell. So the observed price is one of the two sides of the spread. And from this very simple model, they give different assumptions and they try to remove some assumption of literature's estimators to be able to recover the value of the spread S from the moment of the log price increments. So what does that mean? That means that if you have like a minutely bars, minutely open and log close bars, you are able with the estimator, better than with the traditional one, to find what was the spread on the assets. So the authors did 4 different cases. The first one with no serial dependence, the serial dependence is price returns, then with autocorrelated trades, so the trades are going in the same direction, the one after the other, which are like things already studied a bit in the literature on more high frequency part, and a combined model where there is everything together. And what they obtain is like, in the end, okay, there is a lot of math in between, but the formula of the estimators themselves is not that complicated. You have like the L are just sampling intervals, and the V here is just the variance, so to compute, it's not that complicated. And what they do is just rigorously derived estimator for each case of market. So here's the first one. The second one, which really looks like the same as the first one with the Hurst exponent in the case of serial dependence. Then we have the third one that maybe look a bit more involved, but as soon as you try to just do a Peter function, it's literally straightforward to compute. And maybe the more involved is the last one, where I forgot the argmin in the equation, but requires a numerical optimization to be solved. What the author did just after is that they simulate each market condition, and they show that obviously in the specified market condition, in control simulation, their estimators work better. Each estimator works better in the condition than the roll, AGK, Corvin-Schulz estimators from the literature. There is still a small limit to this, because I tried it myself on crypto assets, so I downloaded like this 150 gigabytes of data, computed the daily average bid-ask spread, and tried these estimators because the authors was great to give me their code, so I was able to reproduce the experiments on this case. And it appears that on very small spread regime, in fact, because on crypto there is specific fee structures that made the spread to be very, very small. For a Bitcoin, it's like 10 cents over the price of Bitcoin, so it's much harder to estimate. And in this small spread regime, the estimator perform worse, unfortunately, than the standard ones. And in fact, I pushed it to in the simulation case. And if you lower too much the size of the spreads, the estimator seems to perform worse. But as Matthieu said just before, the goal is to be on more illiquid assets, so it makes sense to have bigger spread on this case. So you just need to carefully select them in the good case. So the strength is that it's clearly derived, mathematically rigorous. It explicitly states each market condition you should use them for, but it's not that explicit for me. The practical limitation is, well, should I use it or not in each case? So that's the hard part. And the fact is, if you don't select the good estimator for the good case, you have an higher risk of error compared to standard estimators that are imperfect in the specific condition in comparison, but that in average are less worse in bad condition. So to conclude, the strength is that it's rigorous, and one of the biggest advantages is that even if the papers can seem tough at first, the derived estimator are computationally straightforward to formula. So they are quite easy to use in the end. And maybe some small improvement I have already discussed with the author would be to, as they share with me the code, to just do like a GitHub repository to share it so people can understand it more easily, or do a PyPy package to share it more easily. But overall, it's well motivated and mathematically some paper. Still a bit work to see when we should use it or not.
So now questions, please announce for whom is your questions before speaking.
Good morning. For the first speaker, through the condition impact, how do you limit the environmental impacts linked to that data storage? What are the solutions for more sustained storage? Second question.
You can have Natascha answering.
Natascha.
Yes. Don't know if this is working.
Could you repeat the question? Is it possible? I couldn't understand it acoustically. I'm sorry.
I repeat.
Yeah.
Through the condition impact, how do you limit the environmental impact linked to data storage? What are the solutions for more sustainable storage?
So you are talking about remote storage of data? So our data set, what we are considering is like an offline data set. So we, and it's pretty, so I don't really need to consider these kind of restrictions because I'm considering meta order data, which is very small in size. Like let's say I have like a data frame of 100,000 rows, right? And not so many features, right? I need like the start, the end price, the volatility, and so on. So I agree. It becomes tricky with cross impact because you need to synchronize your meta order data to the tick by tick data, but like you do this once offline, and then there is not so much that you need to take into account. I also say now we were considering future contracts where we have like pairwise correlation. So with pairwise assets or cross impact, it's not such a big thing, but it's true it increases when you consider maybe a SP500, right? Then you like need to synchronize a huge amount of data. But I haven't faced that issue yet, but this will be a restriction to calibrate those cross-impact models.
Second speaker, how to calculate big ask splits in basic points? What is the negative 5% but offer speaker? I repeat. How to calculate big ask split in basic points? What is the 5% but offer split?
I'm sorry, I don't get the point.
Yes.
In basis points?
Yeah, basic point. Oh, c'est pas grave. On va essayer le troisième.
Let's skip to another question.
Les dernières questions. Pour le troisième. Si.
No, discuss it. He's discussing.
Hi, morning. I have a question on the use of practical use of cross-impact model. As impact is a non-linear function of the trading volume, it is model readily applicable to block trading, and then predict the market reaction to a block trading sell or buy order. And a small question related to what I just said: how to measure cross-impact among noisy markets? And second question for you. Okay. Just I ask. Okay, I ask and just if you have time to answer. So, are not bid-ask spreads better estimated by analyzing market microstructure, quotes, orders, volume, liquidity, features?
Okay. So maybe I quickly start with your first question on block trades. So with block trades, it's true, like you wouldn't really care for the single asset case when you have like one block trade. The only restriction with a block trade would be like what's the liquidity available in the limit order book. But then for the cross impact case, given that let's say you have a big block trade and you take essential liquidity out of the order book, you move the price up, and then depending like on the correlation of the other price, essentially like there's statistical arbitrageurs or so on that they would actually take into account where there was a big block trade and then adjust the price accordingly. So cross impact in that case would be very important because you move the price and yeah.
Yes, but
how do you measure?
So in noisy. Yeah, so essentially you need a lot of data, and this is a problem with meta order, because meta orders, your data sets are pretty small. So what we're actually working on is to enhance our trading data set with meta order proxies, so to have a larger signal to noise ratio, or at least that we can take a higher average and reduce the noise by the square root of like the number of trades that we have. Yes, given that we have already like measured it at so many assets, we would have like expected, like we would have expectations. But I agree, in very illiquid markets, or like it can be difficult. Yes.
Okay, we're running out of time, so I would like to take one last question for the second paper, for Matthieu's paper.
There was one question for me, indeed.
Okay.
The question was about...
Better analyzed and predicted and measured using market microstructure. And I think that market microstructure is something very not insufficiently considered in financial research.
So in fact, what I understand is that maybe we can consider several factors to explain the bid-ask spread. And some years ago, I was working for corporate bonds, and that's true that I think that they used estimators based on factors such as the rating, the size of the issue, or the volume and things like that. And why not? It's just not exactly the same data set, so we don't consider the same information. We could do that. I haven't compared both estimators, but it could be possible to compare them. The difficulty with this kind of estimator based on factors is that you don't consider some idiosyncratic part. Okay, just you consider an average issue, and you don't consider that there may be some differences between some issues with some characteristics, but which are different. And if you base your approach on time series of prices, it's just more based on something which is idiosyncratic. Why serial dependence? Because it's something which I think is realistic. At least for trades, you cannot consider that trades are all independent. Yeah, statistically, yes. Yeah, I think there are some relations that we observe statistically. We can observe for the serial dependence for price increments, it's a bit weak, but for serial dependence of microstructure noise, it's something which is quite obvious.
Thank you. We need to move on to the third paper, so sorry if you couldn't ask your question, but you can speak with them after the session. So now we have Hamza Bodor presenting Deep Learning Meets Q-Reactive, a framework for realistic limit order book simulation.
It's working now, okay. So I said, yeah, thank you all for being here for my presentation about limit order book simulations, and mainly a deep learning extension of the Q-reactive model. So it's work under the supervision of Laurent Carlier from BNP Paribas and Olivier Gaillan from Paris-Dauphine. So this work is in the context of a growing interest in modeling limit order books. Why is that? It is because limit order books, modeling the limit order book has different advantages, such as modeling the market microstructure and analyzing it, which gives insights about price formation and liquidity dynamics. It also gives insights about, or it can be used for short-term prediction of order flow and price movements. And it also can be used for optimal order execution, which is one of the main problems in finance. And building market simulators, which is the goal of this research, can be used in different situations. For example, it can be used to generate synthetic data that can be used for calibrating models, for example, especially data-hungry models like deep learning models. It can also be used to realistically backtest trading strategies in a realistic setting that can adapt to the trading strategies actions. And also it can be used to train and calibrate reinforcement learning agents in a realistic environment. So the literature in these subjects can be split into three categories. The first one is what I call classical methods. These are like theoretical methods that rely on models like Markovian Poisson processes or Hawkes processes. These models assume some statistical regularities in the order flow, and they try to model this statistical regularity using these models. The second category is what I call agent-based models. Basically, it supposes that the limit order book is an aggregation of different agents. Each agent is acting differently, and when we aggregate all of these agents, we have a realistic market simulator. And finally, and more recently, some machine learning techniques like RNNs and GANs have been used to simulate the limit order book arrival of events. So the Q-reactive model of Huang, Leal, and Rosenbaum, which I feel very fortunate to present this work against at least two of the co-authors of this paper. It's a simple and quite effective simulation framework. It actually supposes that the order book can be split into two sides, the bid side and the ask side. So what we call the reference price. This reference price should always be between two prices, such that we can model all the prices. And actually, one variant of this model that we will focus on the most in this presentation supposes that each price is actually an independent queue. And if we focus on a given queue, we can say that it actually can be updated through three types of events. The first event is limit orders, which add liquidity in the queue. And the second type of events is cancel orders, which remove liquidity from the queue, and also market orders that remove also liquidity from the queue. And actually what we suppose is that the arrival of each of these events is a Poisson process. And instead of considering constant Poisson processes, we actually condition these intensities on the size of the queue. So actually the whole queue evolve in a heterogeneous Poisson process that depends on the size of the queue. And the function here, or the equation I wrote, is actually the likelihood of this model. And it can be seen as like, it has two main parts. The first part, the exponential part, is like the models the absence of any event for a duration delta tk. And the second part models the arrival of an event of type eta k that arrives in the queue and modifies the queue. This a slide to present the characteristics of the data we use to calibrate the different models we will present. So we focus mainly on Bund asset. We filter this data into periods of active trading hours from 9 a.m. to 6 p.m. And the table here summarizes the different characteristics of the data we obtain. So we can see that we focus on the top 5 levels of the order book. And also what you can see is that most of the activity of the order book is concentrated on the best levels. So the likelihood I showed earlier admits closed form solutions in the context of the Q-reactive model, and it can be written this way. And if we calibrate this model actually on the Bund data, we obtain curves like this. And what we can see actually is that indeed the intensity of arrival of events depend on the queue size. For example, we can take the market intensities where we can see that the intensity of arrival of market events is very high when the size of the queue is very small, and decreases exponentially as the size of the queue increases. So the Q-reactive model actually successfully captures key stylized facts on the market properties. For example, the absence of autocorrelation between returns, the volatility clustering, and the long-range dependency, which is the fact that in absolute values, the returns are actually correlated, and the correlation of these returns decay very slowly in time. Also, it can capture the distribution of queue sizes accurately at different levels. We have done actually an extensive study, empirical study on these different stylized facts in a work. But yeah, with that being said, the Q-reactive model by design cannot verify multiple stylized facts, such as, for example, the excitation between events. That is because actually the Q-reactive model only consider the size of the queue, and it doesn't take into consideration the history of events to be able to reproduce such stylized facts. Also, it cannot reproduce the interdiagonality because it doesn't take into account time in its formulation, and also it cannot reproduce any sensitivity to order flow imbalance because it does not take that into consideration. So that's why actually we propose the deep Q-reactive model. Mainly it First, it will generalize the states variable. Instead of taking only the queue size qk, we take now a feature space xk, and depending actually on the information we put in this xk, we will show we can reproduce some key stylized facts in the simulated market. Also, instead of considering a pointwise estimation of each intensity for each couple eta size of the queue, we will consider a functional parameterization using neural networks. And of course, instead of a closed form solution using the formula I showed you earlier, we will consider the likelihood of the model and maximize it using neural, we maximize it using optimization. And mathematically, if we take the likelihood of the model, of the Q-reactive model, what we do is that, as I said, we first generalize the intensity function using a neural network parameterization, and also we generalize the Q, the states variable. Instead of being qk, it will be xk, and then we take the negative log likelihood, and we consider that to be a loss that a neural network will minimize. And the first actually use case we try to see is, and are we able to have a model that reproduce the excitation effect, which is the excitation, the fact that like events or order flow events excite each other during like the order flow. And in the figures, what I actually show is the excitation or the transition matrix between events in history at left, with the Q-reactive model in the middle, and with the deep Q-reactive model in the right. And what we can see is that actually we are more accurate at producing the shape of the transition matrix when we use actually the deep Q-reactive model with an xk that takes into consideration the last event. Also, concerning the interdisciplinarity and the fact that market is not constant actually in the time, it evolves and generally spikes during the open and the close of the European markets. We can see here that if we, in xk, we add information about time, we are able to have this interdisciplinarity, whereas the Q-reactive model actually models the average behavior of the market. And more quantitatively, if we consider metrics like the likelihood of the model or the accuracy in predicting the next event, or the accuracy at predicting the time to next event, what we show here is that the vanilla model in yellow, actually, when we add more features, we have better likelihood, we are more accurate at predicting the next event, and we are better at predicting the time to next event. And especially, what we can see is that the model in purple, which is the model that combines both features, is actually better than all of the three variants, which means that actually adding more features helps the model into being more accurate. And that's actually what is said here. But with that being said, until now, the Q-reactive model and the deep Q-reactive model treat each price independently. So each Q is considered to be independent from each other, which is kind of a limiting hypothesis, because as a market participant, I will not see only the information about my Q to be able to act in it. I will see information maybe about the whole market in order to act in the market. And also, these models does not inherently model the order size, the order sizes. So that's also a thing we want to generalize in the further extension, which is the multidimensional deep Q-reactive model. Actually, what it does is, instead of considering each price independently, so the arrival of events will be independent at each price, we will consider only one queue, and this queue actually can receive orders at different price levels and at different types in the same time. And to give you a hint about the difference between the three models I presented so far, so the Q-reactive model is a mathematical formula that takes into consideration the queue size and gives me the intensity of arrival of limit, cancel, and market at each level. The deep Q-reactive model does kind of the same, but it replaces the mathematical formula with a neural network, and it gives me the intensity of arrival of event at the queue. And now with this extension, actually, we have a master model that will take into consideration all the information about the order book and gives me as output all the intensities of arrival of all possible events in the queue. And mathematically, actually, if we go back to the roots, what we want to model actually is to model the arrival of events. What is an event? It's actually a combination of few information. The first one is the type of the event, it's a K. The second one is LK, which is the price at which the event occur. Also, an information is the time until the event. And finally, is the size of the event. So all this information is what defines the event. And finally, all these events happen in a context XK, or in a market context XK. So if we write actually the likelihood of the model or the joint distribution as follow as this equation at the end of the slide, we can write it into two parts. The first part actually, its goal is to determine the type of the event, the price at which the event occur, and the time until the event. And the second part, conditionally on this information and on the market context, what is the size of the event? So we have a blue term and a red term. For the blue term, actually, it's if you can remember, the Q-reactive model's goal is actually to determine the type of the event, the price until the event, and the time until the event. So that's exactly what the Q-reactive model want to model, and we take actually the same formulation of the Q-reactive model, and we adapt it such that we can take the same formula of the likelihood of the model, and in the same way we did for the deep Q-reactive model, we take this likelihood or the negative likelihood as a loss that we will minimize. And for the red term, which is the term that determines the size of the order, we had different design choices, but at the end we stick to the case of modeling the order sizes as a classification method. What we do actually is that we consider each order size as a class, and we calibrate using the data. For each situation, we try to calibrate this classification model, and at the end we will have a model that for each market condition, it will give us the probability of occurrence of each order size, and we will use these probabilities actually to simulate the market, or to simulate the order size. So to sum up all of this, the difference between the model 1 of the Q-reactive model and the multidimensional deep Q-reactive model is that first, it generalizes the state space. Second, it will consider a functional parameterization via neural networks. Third, it will optimize that using like an optimization problem, and also it will relax the hypothesis of Q independence, and finally it will also model the order sizes of the events. And the first thing we thought of is actually to try to see actually if we can like reproduce market impact profiles, and how we managed to do that actually is to include features about the trade imbalance. So the trade imbalance features are defined as follow. So it's just in a given window, so we compute the volume traded at the bid minus the volume traded at the ask over the sum of the two. And when this is very close to 1, it means that there is a high pressure at the bid. When it's very close to -1, it means there is a very high pressure at the ask. And what we did actually is that we measured the market impact by adding an external agent that will unwind the position, apparent order, by splitting it into small orders in a given window, which will be 5 minutes. And what we will see actually is the behavior of the market during the execution phase and after the execution phase. And this figure here sums up actually what we obtain. So in red actually is the simulations where we don't take into consideration these trade imbalance features. And what we can see is that the market impact is linear during the execution phase, and then it stays constant actually after the execution. Whereas when we include trade imbalance features in the model, we have a more concave, even though it's not as concave as one might expect. And after the execution, we have a convex part, which is kind of what we expect in the literature. We have a concave convex market impact profile. And when we do that actually for different parent order sizes, we measure the maximum impact caused by this parent order, we can actually fit a square root function over the maximum impact, which joins the literature on the subject that gives a square root law of the market impact. Also, if you remember earlier, I showed the transition matrix between events at a given Q. Here I show the transition matrix between events at the best levels, so at the two levels of at the two best prices. And what we can see here is that now we can actually produce excitation effects not only within the same queue but also cross queues. For example, if we can see very high values at, for example, when there is a trade at the ask, there is a high probability that there will be limits at the opposite side, limits at the bid and vice versa. And another interesting property actually by doing this extension is the ability to model the variability in the market. So here actually I am plotting the number of events occurring at the simulated market on the real market in 5 minutes window. So we count actually the number of limit events, cancel events, and trade events that happened in 5 minutes, and we plot the distribution. And what we can see is that actually the Q-reactive model is good at reproducing the average behavior of the market, but the deep Q-reactive model is actually even able to reproduce the variability of the market. We can see that the deep Q-reactive model is more variable and has a better volatility compared to the Q-reactive model. To sum up, we have shown how the deep Q-reactive model has enabled to be able to reproduce more stylized facts and more market properties if we add information into the state space. And that has led to the multidimensional Q-reactive model that does this, and on top of that relaxes some the queue independence between the queues, and also it models the order size arrival of events. And we have seen how this helps to reproduce some key stylized facts, for example, the market impact profile and the excitation between the different prices. And the future directions of all of this can be, for example, to extend this to see if it can be applied to small tick assets, and also why not to use this simulator to calibrate reinforcement learning agents. Thank you all for your attention.
Charles Albert Lehal is the discussion for the paper.
Good morning. So I'm very happy to be there to comment this paper. If it works. Which one? Okay. Okay. So let's jump to the essential. As you've heard, this paper is about extending the Q-reactive model. Just one slide about the Q-reactive models in general, and also their comparison with another family of models. So the Q-reactive models are ones that you try to model order book dynamics, and what you do is that you say that the events that are affecting each queue on the order book are modeled by Poisson processes, and the intensity of these processes are simply a function of the shape of the order book. So it's something without any memory, and your hope is that all that you need to predict what is the intensity of the next type of events, addition of liquidity, cancellation of liquidity or transaction, is encoded into the shape of the order book. There is another family of models, order flow driven, that have been initiated by Ramaconte and Adrien Delarare, where they do exactly the reverse. Instead of trying to understand order book dynamics from the perspective of liquidity provision, the order book, they try to model liquidity order book dynamics, taking only into account recent consumption of liquidity. So what they called order flow, that is more or less how many trades you had consuming liquidity at the bid or at the ask. So in the literature, you've got two kinds of models, and what you try to do is to see, okay, what can I explain only with liquidity provision, or what can I explain only with liquidity consumption? And it helps you to understand the mechanisms, the causality, etc. When you focus on Q-reactive models, so really trying to understand the dynamics from the viewpoint of liquidity providers, there is something that is striking, is that you miss to model a correct level of volatility. So you've got far more mean reversion when you focus on liquidity provision, and somehow that's understandable. because what is happening is that conditionally to the fact that the first queue has been depleted, the second queue is in general very high and very large, and so it mean reverse. If you look this way and you have only access to liquidity provision, it's very difficult to recover the volatility. And so in cure-active models, you've got different ways to do that, but it is somehow artificial. And for order flow-based models, so the other family, is exactly the reverse. You have a good recovery of the volatility, but not a good recovery of liquidity dynamics. And here, one of the interesting points of this new model is that it is trying to merge both aspects. So you keep the spirit of the cure-reactive models, meaning that you want to model liquidity dynamics by Poisson processes, which intensities are a function now that is completely linear of what do you want. I mean, you can put anything you want in this big model. Of course, now that you are mixing things, it's far more difficult to understand what do you explain. Are we here in academia to make models that have a good, I don't know, in-sample performance, or are we here to understand what is happening? And it is more or less what is missing from this deep order book model, is that it's a black box and it's very difficult to understand what it makes it work. Even in the paper, authors are mentioning that there is an apparent contradiction that is very important with respect to liquidity dynamics between the recent liquidity consumption and the current liquidity addition. In a stationary mode, they are equal. If you want the order book to keep constant, if you remove liquidity, you've got to add liquidity at the same place. But sometimes it is not what is happening, and it's probably when something important is happening. And so that is something that is missing in the paper. So I took tick-by-tick data, and I put you here for you in this dotted blue, the order flow imbalance in y-axis, so consumption of liquidity as a function on average, okay, it's always average, of the order book imbalance. And it's a straight line. So they are highly correlated. But, and it is the puzzle of this paper that this paper does not explain what is happening. You put two very correlated inputs, and you've got something different in output. So probably there is a conditioning that makes them very different. And what I tried the conditioning is what is the next event affecting the order book. And you see that immediately you've got one of the three events that make the curve very, very different. And it is addition of liquidity. Conditionally to the fact that you will see an addition of liquidity, this relation between liquidity consumption and liquidity provision breaks. That is things that we would like to understand by these kind of papers. And it's completely hidden within the black box. So with non-parametric statistics, you can show and understand far better than with a deep black box. And that is more or less the message of my comments. And a last one about the recovery or the modeling of permanent market impact. I've been very surprised that this paper tries to, just tries indeed, to get a permanent market impact for a model with no information. Because we know from old papers now, 10 years ago, that the permanent market impact is an informational aspect. It is not the meta order that creates permanent market impact. It is because you decided to send the order that you made a good prediction of the future price. If you are a good asset manager and otherwise you are bankrupt, the fact that you send the buy order is conditioned by the fact that the price will go up permanently. And so even if your systems are broken and you cannot trade, you will have a permanent market impact. So it is not your trading flow that implements this impact, it's simply an informational aspect. And so the best you can hope with a good non-black box model is to recover temporary market impact. And so if you've got the kind of curve that the author have, it's because you captured something like, that could be good to be tested, something like during the fitting, I mean the learning period, what was the average amount of information traded by people in this market. And so it's something that has no causal relation. And you cannot, even if you want to trade a reinforcement learning something on that, you cannot reuse this model because it is very related or conditioned to a context that is not the same now. So that is the last point I wanted to emphasize. And even this morning, I saw other papers trying to have a permanent market impact out of the box. It is not the way it works. Permanent market impact is mostly informational. It's temporary market impact that is due by frictions. And so in a lot of, even in optimal trading strategies, you shouldn't try to optimize your permanent market impact once you took the decision. It's too late. The causality is over. Okay. So that's it for my discussion.
So any question about Amsa's paper? I'm going to give a chance to you.
Good evening. What are the deep learning algorithms? What is the deep learning used for? What do you propose as a resonant approach that allows model solution for cross-impact model by showing that symmetry and content requirement are particularly effective?
Thanks for the question. Actually, we propose that deep learning parameterization, like the idea is actually to propose a functional parameterization. So one can follow another approach. What we did actually is to model that with the neural networks, and that's actually what we did.
Okay, any other question? Well, then I'm happy to, a last question over there.
I have a question to Charles Albert, actually. There's a point you made I thought was super interesting, but I didn't get it completely. You drew you decorrelated the two signals. Can you explain it again, please?
No, it's just the fact that the two signals are usually correlated. And on average, they are highly correlated. The correlation is almost 1. But if you condition by events happening in the order book, now they become different. So it means that probably what we suspect, if we try to understand the difference between the the family of Q-reactive models and the family of more order flow-based models, so one by Ramaconte and Adrien Delarare, etc., it's that when the inputs of these two models are not agreeing, something important is happening in the market. So on average, liquidity provision balance liquidity consumption. Otherwise, everything is broken. But when they do not balance, it means that maybe it's fast market, maybe there is an information propagating, so we are back to information. And so I try to select things, events that were probably highly influenced by this kind of events. And so it was not very difficult to find one. And indeed, I just made one attempt. And so that's why I could completely decorrelate these two curves. So when you do a black box model, what is important is to understand why is it better than having only half of the inputs or the other half of the inputs. And if it's the case, it means that there is a very strong correlation between those two families of inputs to kind of features, different features. And it is what I tried to see, because this paper is very challenging in terms of understanding the black box, the mechanism under the black box.
Thank you.
Okay, we're running very late on the time schedule. So once again, thanks a lot to all speakers for making great presentations. And I invite you to stay for the next session about open source databases. My understanding is that it's going to be presented by ILB representatives.
You made a mistake, that's okay. It's about sustainable finance now.
Oh, sorry.
It's okay. Sorry, there was a little mistake about the next session. It's about sustainable finance, not about trading and algorithm. The idea of this new session, if I can go back. Okay. Can we go back one slide, please? Can we go back one slide, please? Okay, thank you. The idea of this session is to introduce you to basically the Park Foundation ecosystem together with the Pladifest program, which was launched a couple of years, 4 years ago now, which is run by Thibaut that will be presenting, and Capucine will present you a use case. The whole idea of the Park Foundation that was launched last year, almost 1.5 years ago now, was basically to foster cooperation between academia, researchers, stimulate really the ecosystem the very same way that the ILB is stimulating the research, the financial research ecosystem, but just focusing on sustainable finance, obviously with a view to deliver an impact in sustainable finance and promote basically its implementation within financial market practices, delivering methodology, tools, and also a number of programs surrounding the data, which at the end of the day, it's the very raw material that we need to conduct research in this area. So it has been designed, and I think Thibaut will come back to that, to leverage data science and develop innovative tools, thanks to the Pladifest program. But also we've been looking at a number of top research priorities. One of the programs that we are undertaking now is to implement a global research cartography of what's going on in sustainable finance research over the world. It's an ongoing program that will take place together with the ESG database cartography that has been implemented with Pladifest, and maybe Thibaut will touch upon that, which is now probably the largest platform to reference ESG database around the world, and basically for any kind of practitioners or researchers to know who's doing what and who's providing what kind of database. We'll do the exact same thing on research, not only ongoing research, but the idea is to promote a more proactive tool for researchers so they can also communicate to practitioners their future agenda, which we think is very interesting. The top research priorities that we presented last year, it's quite interesting to see that over half of the thematic that presented last year are now almost dead or dying, and I think you will understand exactly the reason why. The first one we presented was standardization of the sustainability disclosure framework. I think the game is quite over there. We are not looking, at least in Europe, for more standardization. I think we are looking again about ease of the regulation momentum, and we are looking at basically less standardized, which is a challenge for all of us. It's interesting for researchers, but it's a challenge for overall for the market. The second thematic was basically the massive influx of reported data coming from companies again, triggered by the regulation momentum. Again, I think we have to lower our ambitions on that front. We will get less reported data than what we were expecting on a much narrow scope. The third one that the third priorities that we had was double materiality. Again, double materiality is not dead yet, but it's really at stake. We will see what's going on with implementation of the new CFDR in Europe, CSRD. There are massive calls coming from other countries to basically stop double materiality and come back to simple financial materiality, meaning the financial impact of any kind of sustainability metric. The fourth topic we've been very active on the research front was the decarbonization of the financial flows. This is again not almost dead, but it's dying, certainly. The recent GFANS proposal for evolution, basically to fly away from decarbonization target to rather focus on financing target, is quite relevant in that term. And I think we will have more and more problem to find out basically how the financial flows are contributing to meeting the Paris target objective. And one of the last priority in terms of research team that we had, and we had a number of papers in that direction, was basically the anti-greenwashing thematic, and that's obviously now being taken over by rather greenwashing thematic. All the players are being more discreet and more sober in terms of what they want to disclose. So what's left for us in terms of research, and then I will leave the floor to Thibault. It's certainly the strengthening of the climate risk models, specifically the physical risk one, and everything that is related to natural capital related risk. Obviously, that comes with it the strengthening of all the adaptation thematic. We need more research on adaptation and to understand really the link between adaptation and mitigation objectives. The strengthening of the short term and medium term versus the long term. I think this is quite obvious. Rather focus on 2030, 35 rather than 2050. And this, I think we will see a shift in the research in that direction. And then, and this is a very good transition to the PLADIFES program, the strengthening of the use of alternative data set compared to reported, official reported data set. And I think specifically to cover physical metrics and physical risk issues and adaptation metrics issues, we will need this kind of data set. So this is a very good, I mean, this gives you a flavor of the program of PARC for the coming months and the coming years. And I will leave the floor to Thibault to dig into the PLADIFES program. Thank you for your attention.
Okay. So thank you very much. I've been whispered in my ear plug that I'm going to have to go fast, so sorry about it. I'm going to cut the jokes. Okay, so this is just a quick reminder about the structure of the ILB, the organization organizing this conference. Basically, I'm working at the data lab, so it's a team of data scientists and analysts that are working with the industry and with the researchers. And what I'm going to talk here more specifically is the PLADIFES project, which is financed by GANR, and it's actually the fourth time that we are presenting something at the Risk Forum, so maybe some people already saw me. Basically, what do we have into the PLADIFES program? So this program is about creating databases for research in sustainable finance. Here you can see some of the main databases and products that we developed so far. So the first one is about corporate GHG emission estimations. I'm going to talk a little bit more about it later on, and if you have any questions, please feel free to go to me after this intervention and to speak at lunch. It's going to be more appropriate. We also have a significant amount of developments about physical risks, some of them about how to estimate future damages tied to cyclones, tied to floods, and also how to derive credit risks, future credit risks tied to this kind of hazards. And also we also have a significant amount of work about critical materials, and Capucine is going to deep dive a little bit more on this. Sorry if I'm rushing a little bit. So basically, this PLADIFES program is addressing to all kinds of practitioners, but our first target is actually academics. So that's why we are intervening here. Some of our databases can be used to estimate carbon footprint of portfolio. They can be used for impact. They can be used for risk measurements. They can be used for basically any use cases that you have in mind when you think about sustainable finance. And if you actually have new use cases that we are not covering yet, please feel free to reach out, because we would love to explore more areas with you. One of the main important characteristics of the ILB is that it's not working only with academics, it's also working with all kinds of practitioners, private practitioners, public ones, So asset managers, regulators, policymakers, we are already interacting with the context of the project, with several kind of institutions. So this is just basically to say that it's not restricted to academics. And I'm gonna instantly leave the floor to Capucine.
Thank you, Thibaut. So I'm going to present one of the database on the Platyface platform, which is the CRMI for Critical Raw Material Index. So for those who don't know, critical raw materials are metals such as lithium, copper, cobalt that are needed for energy transition. And what we have constructed with my co-author is an index that tracks the price dynamics of critical raw material through time. So basically, this is a weekly spot price of 28 metals across 6 clean energy sectors from 2012 to 2025. And the index, so this is the aggregation of all these metal price series. The index is weight based on the trade volume associated to the metals. And we also propose sub-indexes for electric vehicle, wind, solar, PV, or hydrogen. So really, if you are interested by critical raw material index, feel free to come to me. We will discuss about it because it has a lot of different application. The main idea is that it will allow to further research and studies on that kind of subject. So for researchers, for instance, it can be used to conduct empirical research, but also to construct scenarios. For policymakers, it can be used to conduct stress tests, for instance, to analyze how the European Union can be resilient toward a critical raw material shock. And for practitioners, it is always interesting to assess how our portfolios are subject to a different type of risk, and notably critical raw material risk. So once again, please, if you have any question or if you want to just do research on critical raw materials, feel free to visit the website, feel free to come to me, and I think that's it.
Yeah, so thank you very much, Capucine. So I'm gonna try to go a little bit slower on this slide because actually I think it's more interesting to take some time to discover a practical use case. So I'm gonna talk about COGEM. COGEM actually standing for Corporate GHG Emission Estimates. So it's a database that we created 2 years ago, and the goal was really to be able to provide academic and the practitioners with something that was addressing the main pain points that were recurrent when dealing with scope 1 to 3 emissions, scope 1 to 3 corporate emissions. So what we developed is a state-of-the-art methodology based on machine learning algorithms to create a database with no holes. So it means that we have this database available for all the listed companies, so it's around 50K corporates, and we have estimates for all scope 1s, all scope 2, all scope 3s, and all scope 1 to 3s. So it's more data that you can have, for example, in most of the data providers, such as MSCI, CDP, and so on. It's estimated data, so it may not be suited for all use cases, but actually for most of the use cases, it can actually be relevant, if not more relevant than the reported data. Because it's comparable, it's homogeneous, and it's transparent. The methodology is available on GitHub, and all the data has been obtained the same way. So as I mentioned previously, it's something that was released end of 2023. So we already have some users that are currently doing research and also open tools with these databases. So we have, for example, the Banque de France that has some research teams using COGEM for deriving metrics on transition risk and on the on the assessment of the greening of the financial system, the French financial system. We also have the OECD that is using this kind of data for actually a wide range of use cases, and also some individual academics in France, but also in the US and also in Asia, I guess. And we also have a CPI, Climate Policy Initiative, that is also using this COGEM data in its latest version of its financial tracker. So we are kind of proud that this database is being used and that is serving the purpose that it was designed to. So if you have any questions about COGEM, about the PLADIFEST project, I know that I've been rushing a lot the presentation, but really you have a lot of information on the website, and once again you can come to me directly. Thank you very much. Yeah.
Thank you for the presentation. I'm an assistant professor in finance and doing the climate risk estimate. So I do both physical risk and also transitional risk. I'm very interested into your corporate greenhouse gas emissions estimate, because I saw that you are using machine learning algorithms to do the estimate, and it lasts for 15 years. Are you also capturing the sustainability report the companies reported, and then integrate the actual data into your model?
So actually what we have in the database is that we share the estimated scopes, and we also have an indicator that indicates if whether or not the company has reported emissions, but for legal reasons we can't share the reported emissions. But if you have, I mean, they can be easily accessed depending on the amount of comparisons that you are looking at. You can usually find this information.
Yeah, the reason why I'm saying this is that, for example, especially the US listed companies, they publish the sustainability report on the ESILV website. So you actually can use some texture analysis to get all the carbon emissions, which I think it would be very good for your model.
Yeah, it's just, I mean, it's just that it's additional work, and the heart of the idea of this COGEM database was to have something that was homogeneous, so that we believe that it was more plug and play this way, but it's something that we can propose to. And we also have like complementary data, but it's just that it would actually require some significant investment to have something relevant to propose.
Yeah, I think I'd like to discuss this more with you. And the second question is that, are you also measuring the transition risk or only physical risk in this project?
So physical risk, it's more, let's say, custom collaborations to date, because so most of the modules are still into ongoing developments. But yeah, that's something that we can talk about it.
Okay, thank you. I'll talk to you after this.
You're welcome. There's a question.
We have time for one more question? No, I'm sorry, we don't have time for more questions. We have to end up the sessions. And to pass the floor to, is Marie taking the?
I believe it's the score price, right?
Let's check that Philippe Renard is giving the prize.
Okay, so, okay, then we may have time for one question. Okay. Who has questions? Only? Okay. If you can be quick, please.
For the time being, you are using the ERP platform. You have not upgraded the sector underground platform in the business area, strong in potential consideration.
I didn't get the platform that you're mentioning.
You haven't used the ERP platform because now you use only CRME platform.
On the critical materials, you mean? The CRMI, it's an index that Garcin developed, and basically it's using a wide range of prices available through Bloomberg, Refinitiv. So it's a handmade handmade index. You can't really find it anywhere outside of our website. And
thank you very much, Thibaut. Thank you, Capucine, and thank you all for your attention.
All right, so my name is Marie Brière. I'm chairing this, the scientific committee of this conference, and it's my great pleasure and honor to welcome Philippe Trainard, who is the director of the Fondation SCORE pour la Science. And we are very happy to deliver a prize that you are giving. So maybe I will leave you the floor.
Thank you so much. I think, yes, you hear me. Okay. Just a few seconds, and I am very happy to be there, and I have to confess that the SCORE Foundation for Science is proud of the partnership with the Financial Risk International Forum we have each year by definition, and with ILB and EIF. And I think that this year shaping financial research forum is especially stimulating at the time of intense data and artificial intelligence competition, not only work, but if I look at the international context, is just a huge competition and around the world. The foundation itself is dedicated to risk and its coverage, knowing that risk analysis is at the same time, of course, partly an art, but also a science. And therefore, today is more the scientific pillar, of course, which we would like to underline and to distinguish. Risk, of course, we are interested in risk in credit because by definition insurers are investing. Risk in asset management also because by definition 1/3 of our activity is risk management, and asset management teams of insurance company are big teams, even if they are more and more becoming independent. And of course, insurance. And this year I am especially, as the director of the foundation, excited by the winner who has been focusing, and I will not give the name because I leave to Marie and to present the exceptional winner, has been focusing his work and his studies on informational frictions, on learning about competition, which is a kind of information which is especially acute for us and acute for everyone, because in all our sectors, competition is the main risk. By definition, sometimes people are forgetting that. It's, you know, I would not have any competition when I have confronted with a big risk and I have not been anticipating, my solution will simply be to raise the price. But because of competition, it's not a true solution. And last but not least, maybe the winner has been spending time on the effect of monetary policy, especially of quantitative easing, and at the time being, we are confronted with the consequence of quantitative easing, and we no more know what is truly the true, for example, discount rate for the future in a time of quantitative easing. And therefore, I am very happy, but give back the floor to Marie, who has all the competence to present the winner.
Thank you very much, Philippe. So, okay, let's stop the suspense and give the name. So we are very, very pleased to welcome Professor Olivier Darmouny. So, and give you this award. So let me, in a few words, and then you will have more time to present yourself, but give a little bit of a summary of what you've been achieving so far. You're a distinguished financial economist with research interests that encompass corporate finance, banking, monetary economics, as you said, Philippe, with a keen focus to understanding how frictions, and in particular asymmetric information, impacts credit markets. And you employ a variety of methods from empirical analysis to theoretical models, so you're like a complete economist to shed some light on these critical issues. Recently, and we've been discussing about that yesterday, you've been, for example, conducted significant research on brown capital reallocation, which is a very, very important topic today, also to relate to the past session. So, examining how the ownership dynamics of coal power plants, which are one of the largest source of carbon emission in Europe, has evolved through time, and you document a sharp increase in private and also domestic state ownership of these plants, which is accompanied by a notable decline in foreign public equity ownership. And this work has very, very important policy implications, because it's highlighting that nationalization by state investors who prioritize social factors such as job security, energy stability, can inadvertently hinder the progress of green finance. So it's just one example of how relevant this kind of work can be to the current discussions, and in particular for policymakers. So your academic journey is impressive. So you earned a Bachelor of Science in Econometrics and Mathematical Economics from LSE, then a master's degree from Toulouse School of Economics, and then you completed a PhD in economics at Princeton University in 2016. So today we are very, very honored to present you with this award in recognition of your outstanding achievements and your commitment to advancing the field of economics. So congratulations, Professor Darmoni.
Merci infiniment. Merci infiniment. Merci, c'est un grand plaisir. It's a great pleasure to receive this prize.
You did not receive yet.
It's a virtual prize. It's a real prize. Thank you.
Yeah.
Thank you so much. Thank you so much. I want to thank wholeheartedly the SCORE Foundation, the Louis Bachelier Institute, and the Institute of European Finance for this prize to join the distinguished list of laureates before. I think it's a fascinating time to do economics research on topics, financial institution, monetary policy, energy transition, things that I've been thinking about. But the first thing I want to say is I want to ask myself why I am here today. And I think there's two proximate reasons. One is that I decided to do a career in academic research, and second, that there are people like the SCORE Foundation and the Louis Bachelier Institute or Europlace Institute that value academic research and think that it's useful and are willing to give out awards like this to recognize this. But there's a deeper cause. The deeper cause is that we both understand the value of academic research and that it's one of the key drivers of the pursuit of knowledge, of driving our civilization since millennia. And I think it's important to recognize this today and remind ourselves of this in times when many people pretend to forget it.
Merci beaucoup. Encore.
Merci infiniment.
Encore mes félicitations. Très, très intéressant. Merci. Donc on va étudier votre œuvre un peu plus.
Merci.
Grâce à vous.
Merci beaucoup. I'm just going to take a few minutes to share just one idea that I've been interested in the past 10 years. I'm not going to give you the incessant survey of all the very academic paper that I wrote, but I want to say a word about bond markets and financial stability. Now, depending where you come from, that might be a little bit of a strange proposition, because when we think about financial stability, we usually think about banks. Think about liquidity mismatch. For example, Diamond Dybvig won the Nobel Prize just last year. Banks fund themselves with short-term deposits that are demandable, but they invested in liquid loans. In bad times, that can create instability spiral. As depositors take their money out, banks have to sell illiquid loans. That's going to reduce the value of the banking system and going to precipitate additional selling, starting an instability spiral. Bond markets are kind of different. Like the canonical view of bond market, which is of course incomplete, is that bond markets, bonds are held by long-term investors like insurers that have very long-term liabilities, and no one cancels their insurance policies in that time. So you can first order think we might not worry about bond markets when we think about financial stability. I want to think about just two ideas that I've been working on about why that's incomplete. Of course, you can think about many others, and this is why it's such an exciting topic. First, we want to think about how the central bank plays into that, and that's something that I work with my co-author Alex Rodiansky. If you think about what's on bank balance sheet outside of the illiquid loans, these are going to be bonds. And that matters because one of the main tools that the central bank is now using for financial stability is bond buying program, namely quantitative easing, often at the massive scale. We see that used all around the world in 2008, 2012, 2020, and probably for the foreseeable future. And the balance sheets of banks have expanded massively as they bought bond from the bond market. Now that actually matters for banks because if you think what's on the balance sheet of banks, that are notes, these are bonds. And so it means that QE purchases, in addition to just lowering long-term rates, also can help financial stability in the banking sector by improving the value of bonds, reducing the need to sell illiquid loan, and kind of stopping this liquidity spiral. If you think about it, this is just the reverse of the SVB crisis, where the value of bonds going down create deposit outflows and created lots of issue in the banking sector. That's kind of the reverse of that on the positive side. Now, another idea is that there can actually be liquidity mismatch not just for banks, but also for non-banks. In recent decades, many of you are aware of this. There have been new players in the bond market, namely mutual funds, that are investing in bonds, but actually are issuing equity shares that are also demandables. They're not bank deposits, but you can redeem them at short notice, creating a liquidity mismatch between their liability and their assets. What happens in 2020, at the outset of the COVID pandemic, is that there were a lot of mutual fund outflows that actually forced these mutual funds, these non-bank intermediaries, to sell bonds to meet this redemption. The selling pressure led to price decline, and price decline triggered further mutual fund outflow as the value of the fund goes down and more investors wanted to take their money out. So you have the same sort of liquidity spiral for banks that can also exist in the non-bank financial sector. And the last thing I would say is that central banks, again, have a direct role to play because bond purchase programs directly help to alleviate price decline in corporate bond market, directly acting as a stabilization policy or even some form of bailout for non-bank investors. So I hope that these two ideas can kind of make you think more broadly about financial stability in a modern financial system where traditional banks are not the only source of intermediation, and bond markets and institutional investors as well as central banks are equally important. Thank you so much.